Let's talk about Chapter 11. Chapter 11 is kind of the next step from Chapter 10. So recall in Chapter 10 we learned about the capital budgeting methods like NPV and IRR and MIRR. And in that chapter, they just gave us the cash flows. They just said, here's the cash flows, go compute the answers, kind of go from there. This chapter is actually how do you come up with the cash flows. So we have a project, something we want to invest in. This will tell us how to compute the cash flow. So that's what the difference between the two chapters is. And then as we do that, we have to kind of talk about risk and options when it comes to capital projects. So the big topics are cash flows, risk, and then real options. So this is very similar to the graph for Chapter 10. We talk about cash flows up here. Remember that the net present value is the present value of all future cash flows minus the initial cost. But then we're also going to talk about risk and how does risk affect what we think the cash flows will be in future years. So they're going to give us a pretty simple example here to start out with. This is a proposed project. The initial cost is $200,000 to buy equipment or machinery. There's a cost to ship the machinery and $30,000 to install it. So the total cost is everything to get the machine up and running, whatever the project is. The economic life is 4 years. The salvage value when the machine is done is $25,000. And this MACRS stands for Modified Accelerated Cost Recovery System. And it says 3-year class. Now that 3-year class really means 4 years. Why is the IRS developed this, so that's the only reason why that it might be. But when you see MACRS 3 years, it actually means it's a 4 years worth of depreciation. And then whatever this machine makes, we're going to sell 1,000 units per year. The sales price will be $200 per unit. Our cost will be $100 per unit, plus we need to invest in net working capital, which is 12% of sales. So remember what working capital is. It's your current assets minus your current liabilities. So it's, you kind of think when you start to make some new product line. So you buy new machinery, make a new product line. You then have to buy raw materials, right? So we have to acquire raw materials to make the product. We'll then sell the product. We'll have receivables on top of that, plus we'll have payables to pay for the inventory. So the increase is kind of your current assets minus your current liabilities. We need to have more of all of those items because we're launching a new product line. The tax rate is 25%, and the cost of capital of the project we determined to be 10%. So the word incremental, when you hear the word incremental, I want you to think change. So we're launching something new, a new project here, new machinery, new product line. So incremental is how will our base situation be different with this new initiative, with this new equipment and new product. So incremental just means change. So incremental cash flow is cash flow with the project minus cash flow without the project, which would be the base case. Okay. So that's what incremental means. How much more cash flow will there be because we're doing this? The next question is, should we subtract interest expense or dividends when we calculate cash flows? And the answer is no. We don't take those things into account because the cost of capital already does. So when they told us there's a 10% cost of capital right here, that really does take into account whatever capital sources that we will use to pay for this expansion. And they didn't tell us if we're going to borrow money, if we're going to sell shares of stock or whatever. And it doesn't matter because that 10% represents an average cost of capital for the project, but that would assume we're using all sources of capital. So we don't specifically subtract for dividends or interest when we do these kind of calculations. The other question or other thing that they bring up here is, let's just say last year we spent $100,000 to improve the production line site. Should this be included in the analysis? And the chapter talks about the concept of a sunk cost. And a sunk cost is something that has happened in the past, that cannot be changed. And we only want to focus on incremental costs going forward. We don't want to look at the past. And this could have maybe been, let's say, a market study. Maybe we spend $100,000 on a market study to determine if we make this product, this 1,000 units of product for a year, is there going to be a market for it, and what should the sales price be, and so on. So, they talk about production line site, that's fine, but think of it as a market study. And obviously, you shouldn't spend money unless you know for sure, will we get a return? If I make this product, will there be a market for it, right? So that's kind of really what we're looking for. But a sunk cost is something that's happened in the past, but that cannot be changed. So again, we're focusing on incremental. And incremental really focuses more on the future. So this particular plant space is empty, and that's what we're trying to figure out. We spent $100,000 last year to improve it, and now we're trying to figure out what should we do with it. And we've got two options. We can buy this machinery, make a new product, or we could just lease it out to somebody else. Okay. If I lease it out to somebody else, I'll make $25,000 a year. And so after tax, after the 25% tax rate, that'd be a net $15,000. So remember that we're focusing on the cash after tax. So if I go ahead and I buy the machinery to launch the new product, that means that I have given up the opportunity to lease the space out. So it might seem odd in finance, but we do need to take into account opportunity cost or incremental cost. So I gave up one opportunity to get another, and so this is money I've given up, $15,000, in order to make more money, hopefully, by buying machinery and making this new product. In accounting, we would never charge ourselves for this. There's no journal entry for opportunity cost. But in finance, we're really focusing on cash earned or cash not earned because we gave up an opportunity. So we do need to include this in our cash flow analysis because this is cash I gave up by not doing the leasing. So it's a little bit different concept than what you might think. Then externalities are basically think of them as side effects. If you take a drug, there might be a side effect. Externalities could be either positive or negative, but it's something to consider. How will this affect other things that we currently do? So what we're saying here, if we go ahead and launch this initiative, we spend the money, buy the machinery, make this new product, we determine that if we do that, we're going to negatively impact sales of our current products by $50,000. What do we do with that? Well, we charge that to the project because that's cash that we're losing. So we need to include that loss of cash in the new analysis to take that into account. So that's a really common one when you build a new store. You have one store in a city. You decide, let's add one more store. Well, there's a really good chance the sales at the existing store are going to go down for a while. Obviously the goal is that the combined sales of the two stores will be plenty, but it makes sense that the additional store will take sales from the original store. So it's something kind of like that. And so depreciable basis is all the costs that went into getting the machine, the equipment ready to go. So that includes cost, shipping, and installation. And for our particular project is $240,000. We then depreciate that using the MACRS rates. And when we do some problems, they typically will give you those rates. They come from our chapters, an appendix in chapter 11 that has a bunch of information about depreciation. All the rates are printed in your book in the appendix for chapter 11. But most problems will just give you the rates within the problem too. But this is determined by the IRS. Remember, it stood for Modified Accelerated, and the way the IRS tax code works for depreciation is you get a lot of depreciation right away, then it just drops off dramatically. And there's a reason for that. It's because depreciation is tax deductible. And so the IRS wants to give companies an incentive to spend money on big ticket items because that helps the economy, right? So if we're this company, we're buying machinery, well, another company had to make the machinery. which meant they had to employ people and buy raw materials and so on. And so the IRS is saying, let's give companies incentives for spending money on big ticket items and then getting a tax break for depreciating those. So the good news, if we spend this money, we can depreciate this asset, and we can take quite a bit of depreciation the first couple of years. Then it drops off to just almost nothing at the end. Okay, so then we look at, if we buy the machinery, we make 1,000 units per year. What's basically the sales price, the revenues received, minus the costs. And you can see here that we're kind of factoring in a 6% increase in price, and we're factoring in a 3% increase in cost. They don't really come out and tell us that. We have to kind of just figure that out. But what they're saying is we'll make 1,000 units every year. Sales price will go up by 6% per year. We suspect our costs will go up by 3% per year. And so that's just a matter of taking our sales and then minus the cost. So sales minus cost, that would be our net cash flow. And then it just talks about inflation. So, you can treat inflation as inflation. You can treat it as just programmed increases in prices to keep up. However you want to call it, it's pretty common that prices, change every year. But they just kind of want us to know that if there will be inflation, if there will be price increases or cost increases, that you need to factor those into the analysis to get, as best of a result as you can. Okay, so that's what those talk about. So they're going to put together then what they call the NOPAT, net operating profit after tax. Kind of think of this really as an income statement. Sales minus cost minus depreciation is my EBIT, earnings before interest and tax. And we talked a lot about those terms back in cost management. And then we tax that at 25% to get net operating profit after tax. It's just basically your net income, not including any interest or anything like that. And you can see for year 2 what that turns out to be. And in year 2, it's a loss because of that big depreciation hit. So remember, years 1 and 2 have a lot of depreciation. Also remember that depreciation is a non-cash expense. But we do need to include that so that we get the right tax computation. So in year 2, because we have a negative EBIT, we actually get a tax benefit because of that. And then in years 3 and 4, our EBIT's positive because the depreciation drops so much. And so we can see what our tax is in our NOPAT, $52,000 and $68,000. So the next step here is kind of critical. And so you take your NOPAT, just think of that as your net income, and that's after tax, and you add back depreciation, because remember, in finance we care about cash flow. In accounting we care about net income. In finance we care about cash flow. And so because depreciation is a non-cash expense, we have to add it back to our net operating profit after tax. So I take my net operating profit, add back depreciation, I get my operating cash flow. So this is what matters right here. These 4 years of operating cash flows are really what I need to ultimately figure out, will this project work? Okay. And so one more step that we're not quite done. The problem mentioned that there's a 12% increase in net working capital and 12% of sales per year. So initially it's 24,000, 12% of the first year sales at 200,000 and so on. And in year 4 that recoups. So I want everybody to kind of see that in year 0 we got to spend 24,000 to buy all the raw materials and whatever we need to get this project rolling. And then every year that's going to go up. And then in year 4 we sell everything off. In year 4 the project winds up, the machinery is obsolete. We draw down the inventory balance to nothing. We pay off any accounts payable for the inventory. We receive all the receivables, and so it goes down to 0. So what we care about is what's that net change every year in the cash flow. So that net change is really what matters. In year 1 we spend $24,000. In year 2, we unwind it all, we get $26,000 back, and the small changes every year in between. Okay. Then also we have to book or think about the salvage value. So remember, when the project is over, we'll have depreciated the full amount, that $240,000 away, but we are pretty certain that the machine, we can sell it for $25,000 as scrap or whatever. So, but we believe we can sell it for $25,000. So what we do is you take the $25,000 value minus the book value, that's your gain or loss. So we've depreciated it all away. So that's the zero book value. So we'll have a $25,000 capital gain. And so we then tax that gain at the 25% tax rate. And what's left over is the after-tax salvage value. So we'll expect to receive net cash of $18,750 in year 4 once the project is over and we sell off the machinery. It says, what if you terminate a project before the asset's fully depreciated? It's the same calculation. It's just that you will have some depreciation then, or you'll have some book value left over. So basis is original basis minus depreciation. So the basis was $240,000, then minus whatever depreciation we've taken is book value. So book value is just basis minus depreciation taken. Okay. And the cash flow is sales proceeds minus taxes paid. So the example here is, what if we determine that we sell the project, or we sell the machinery in year 3. So instead of keeping it for the full 4 years, we're going to sell it at the end of year 3. And it says after year 3, we'll have 17.8 left over of basis. The sales price, the salvage value is still 25. And so the gain is smaller now. It's only a 7.2 gain. The net tax on that. So we got a 1.8 tax on that. And the cash flow is 25 minus the 1.8. which is 23.2. Okay, so that's just one thing. That's just how you calculate if we do this in a different year. And then it says here, what happens if the sales price is only $10,000 in year 3? It's not the $25,000. Well, then we have a capital loss. And if you have a capital loss, you get a tax break for that. You get a tax credit. So you can see here, we actually make $11,000.95 if we sell it in year 3 and only sell it for $10,000. We get a tax break on that because we take a capital loss. Okay, so this shows us then, we'll go back to kind of the original years 1, 2, 3, 4 with the base case scenario. So in year 1, remember, we've got the $240,000 cost to buy the machine. We have a $24,000 net investment in working capital. And then, so that net operating working capital cash flow, this is the changes every year. And we've got the positive cash flow in years 1 and 2. Then we've got, look at years 3 and 4. And then we've got the change here in year 3. Then in year 4, we have the final year to make the product. We recoup the net operating working capital at $26,225, and the salvage value after tax is $18,750. So in year 4, I'm getting these big bumps here in cash. And in year 1, of course, I had those initial cash outlays. Okay, so then we just go ahead and we plug this into our net present value in our IRR models that we used in Chapter 10. So to calculate this, you just pull up your Chapter 10 Toolkit Excel file, and you would just plug in the appropriate numbers. And we get net NPV is 62,593. IRR is 20.1%. Remember that the cost of capital was 10%. So IRR on this project is double our cost of capital, and NPV is a very healthy number, 62,593. So the decision would be yes, we would run with this project for sure. And then they should calculate the MIRR for the project also. Again, using the Toolkit Excel, you can do that. Don't worry about how to do that in a calculator. You can just use the Toolkit Excel model for that, and we get the MIRR of 16. Which is well above 10, so we'd still be going with a yes. And the profitability index, remember, is the present value of all cash flows divided by initial cost. The decision rule, if it's above 1, we would generally say yes. And it's a very healthy 1.24, so we would again say yes. And they calculate the payback. They get 2.8 years with the payback, and then discounted payback is 3.3 years. Okay, so that's just a good example of how you come up with cash flow, taking a few things into account. And the other big issue to think through is risk in capital budgeting. Remember that risk is measured by beta. The beta of a company is a measurement of the risk of that company. And that you can apply the same concept to a project. You can determine what is the risk of a project, because really the risk of a company to some degree is the sum of the risk of all the different kinds of projects that it takes on. So just like you would have an investment portfolio of different stocks with different betas, a company itself would have a portfolio of projects that they invest in, and each project would have a different beta. And obviously a company should have a mix of safe projects, risky projects, and some in between. Okay, but that's how you measure risk for a project. Now, it says here, is risk analysis based on historical data or is it subjective? It's a little bit of both. You can maybe use historical data if the project you're looking at is similar to projects you've done in the past. There might be some history to lean on. But if the project is completely different than anything you've ever done before, you really wouldn't have any history. So generally, it's going to be more subjective. Kind of just what's the feel, what's the general knowledge of the people making the decision, how much experience do we have in the industry, and so on. But it's going to be more of a judgmental call. Most risk is judgmental. There are 3 kinds of risk to look at. It'll be helpful in your homework, and when you do the test that covers this chapter, you will have to have a bit of an understanding of the various types of risks. So they're all just right here. We'll talk about each one in a bit more detail, and obviously your chapter describes each one. They give about a page or 2 in the chapter for each one of these. Standalone risk is if we just look at that project by itself. Okay, does not take into account diversification. Let's just say that particular project, let's just say the project we just looked at was the only project that this company had. Well, that's standalone risk, right? Now, obviously, companies have all kinds of projects going on, but standalone risk is just the risk of that one project. And then probability density just kind of is going through that process of saying, what's the probability of certain returns? The expected return would be the highest NPV, but the flatter that distribution is, the larger the standard deviation, the larger the standalone risk. And so the steeper that is, the less standalone risk there is. Corporate risk is basically saying, if we do this project, how will that affect the riskiness of the corporation as a whole? So that takes into account all the various other projects that the company has going on and how diversified those projects are. What's the portfolio of really risky projects to less risky projects to medium risk projects. So just kind of looking at how does this affect the risk of the company as a whole. And market risk is saying, how does this project affect a well-diversified stock portfolio, taking into account stockholders' other assets, okay? But it can be measured by the project's market beta. It says here, how is each one used? Market risk is theoretically the best one. However, most stakeholders would look at corporate risk, and so corporate risk is probably also relevant and probably the easiest one to measure. I'm sorry, standalone risk is the easiest one to measure and is more intuitive because we can measure the risk of that project. And we don't get into how to measure the risk of a project in this class, but it can be done. Again, you can kind of run models and do some what-if scenarios and so on to kind of figure out what is the risk of this project in general. And that leads us to sensitivity analysis. And that's kind of playing what I call the what-if game. And if you have some models built in Excel, and you can buy software that does this for you too, is what's nice about having a model built in Excel and using kind of just some inputs and then seeing if you change one input, how does that affect the answer? So for example, for the scenario they gave us in the example, it would be, what if we didn't think we could raise the price every year? We showed that we'd raise the price by 6% per year and costs would go up by 3% per year. So if it was me, I'd want to run an analysis that said, what if we actually had to either keep prices flat or they would decrease? Would the project still work? Because what if some competitor jumped into our marketplace and lowered prices? Could our project survive that and still be profitable? What if we couldn't sell 1,000 units? What if we could only sell 800 units or 750 units? I'd want to change that one to see how does that impact the bottom line and so on. So, this one, the what if sales decline by 30%. So you just change one input, one variable, and you see how does that impact NPV and IRR. So if you got your formulas built well in an Excel spreadsheet, it's really easy to do. I just change one number and see what my new answer is. Then you can kind of build a table that would kind of give us the answer. So what I could do is go, my base case was right here. We're going to sell 1,000 units and increase prices by 6% per year. Well, what if I only sold 850, 15% drop from that 850 units, or a 30% drop from that 700 units, or vice versa? I sold more than I thought I would, and so on. How does that ultimately affect the answer? And you can see then I get various ranges of NPVs. The good news is I could survive a 15% drop. Can't survive a 30% drop, but I can survive a 15% drop, and so on. So you want to look at what's the statistical probability of that happening, which is a little bit of a judgment call, right? We've got the base case that works, and that should be your highest confidence area. But we have to take into account what happens if sales either go down or up. And so you can kind of graph all that to kind of help you figure out what's the probability of something turning out the way you want it to. So that's very important to do if you are doing this kind of analysis. Okay, the steeper the lines show the greater the risk, which is important. These lines have some steepness to them. They do. They could definitely be steeper, but that's what's nice about graphing that. Okay, but typically what managers can control is cost and sales demand, right? So those are usually the biggest variables, is what will it cost us to make this product and what will sales demand be, which means maybe we have to advertise and stuff like that. Now, of course, it's not perfect. It's not taking into account diversification and so on. So it ignores relationships between variables also. So these analyses are not perfect, but they still should be done because they just give you some good information, especially when it comes to standalone risk and which variables, if they change, will affect us the most, right? If it's sales volume or price or cost or whatever that is. Plus, it helps us kind of figure out what would be the break-even point for the particular product too. The real options are things we can do during the project's lifetime to hopefully make results better. So if we get to year one and we're not selling the right amount of units, or the pricing isn't working out, or our costs are different than we thought, real options are things that we can do in real time as market conditions change adversely for us. So the more real options we have, the more likely that the project will succeed. Okay, so a real option could be, could this machine be used to make a different product, that the product that we thought was going to work didn't turn out to be a winner or a hit? Could it be used to make something else? If the answer is yes, well, that gives me more options, which means risk goes down. Will this product line allow me to get into new markets? Would it allow me to compete better with my competition? So those are all questions that have to kind of be asked. And sometimes the best answer is just we abandon the project, we contract, or we just temporarily suspend it until market conditions improve. So, but the more options we have, the better off any project is. Okay, so that was chapter 11. I think you'll find it informational and useful when you do the homework.